you everybody for joining us today, both in the room and virtually. We have a wonderful topic ahead of us today on the topic of the return of carry. Given all the events going on and kind of the macro landscape, we'll touch on some of that as well. So without further ado, I'm Paisley Nardini. I am a asset allocation strategist and portfolio manager at Simplify. And I will let our three panelists introduce themselves, starting with Charlie McGarraugh.
Hi, everybody. I'm Charlie McGarraugh. I am the Chief Investment Officer of Altis Partners, which is a Jersey Channel Islands-based managed futures platform.
I'm going to be a little longer than that. Hello, everybody. First of all, thank you, Paisley, and thank you, Paul and David, for having me. My name's Ed Wolfe, and I am the managing member and CEO of Wolfe Research, which is a firm I founded in April of 2008. And we started with me as the only sell-side analyst. I covered the transportation sector for 20 years. Today we have 30 lead analysts, and we focus quite a bit on macro and in quant and risk as well as every major sector. And we've been fortunate enough that we compete with the large banks, and as a firm we rank generally 5th or 6th in their own broker votes and in II. So we compete with much larger banks really well, and I think a lot like Simplify, we do that by being really focused and really connected to our clients in a way that they don't get from bigger firms who care less about what we do. And I think that's really an important lesson for all the entrepreneurs out here. We have a very entrepreneurial spirit at our firm, and we like to partner with people. We are a growth firm, and in the 16 years since we've been founded, we've grown at over 20% a year, and we hope to be number one in the next 5 years in what we do, which is primarily equity research. But we also partner with lots of people. We partner with those same competitors on the sell side, and we use them for prime brokers, and we trade swap and options, derivatives. We do capital markets through them. We like to use other people's balance sheets and things like that. And we also partner with tech firms like Omega Point, EDS, and Marquee to help market and distribute our factor models and risk models. We have risk models that we think compete very well with Bar and Axioma and other technology companies. And we also partner, and we're thrilled to partner with Simplify on currently 2 ETFs that we provide the machine learning on. And the head of our quant team and my partner, Ian Luau, will be speaking about risk at 2:50 later today. So hopefully you'll get to hear from him. But we really appreciate the partnership, and we're looking to launch several more ETFs together with Simplify over the next several months. Prior to Wolfe, as I said, I was a sell-side analyst doing transports. And I'm just thrilled to be here with Paisley, with Charlie and Jonathan, who actually know what they're doing around the carry trade, and I'm here to learn with everybody else.
I'm going to try to hit the middle spot in terms of length. I'm Jonathan Treussard. The story begins, at the beginning, I'm a PhD economist. I moved from California to Boston to get my doctorate. I thought I was going to be a microeconomist. I loved everything having to do with decision-making under uncertainty. And in my 3rd year of grad school, I walked into the business school, and a guy who's since become my father-in-law, Tzvi Bodhi, said to me, everything you love about economics, in the real world, we call it investing. How about you do that? And so I had the great fortune of actually learning what that means from some of the greats, people like Bob Merton, who gave me my first job. And so I am an option theorist by training. And the reason I'm saying this is relevant to today's conversation. By the time I was done with my doctorate, the world had decided that it was a more interesting thing to do to go into the practice of investing rather than teaching. It was late 2007, early 2008. I joined the Ziff family office here in town as they were building up a more complete risk management team as there were clouds on the horizon. I spent the entirety of the financial crisis and its aftermath working for the Ziff family in risk management and investment strategy. Having spent a little bit of time in California in my youth, I decided to go back and I became a partner and head of product management at research affiliates in Newport Beach. I have since started Treussard Capital Management, a boutique wealth management firm that really is the sum total of everything I just told you, my experience, my knowledge, and I hope serves my clients in a very different kind of way. And again, I think it's one of the common threads among everybody on the panel today is serving clients from a different angle, hopefully a better informed angle, but again, kind of not towing the line. And hopefully that's what we do with this panel is kind of lead with authenticity.
Perfect. So let's jump right in. And before we do, I thought it was a little bit humorous, per se. I was looking on Google, just the news around the term carry over the last few months. I think it's definitely risen in popularity, and Google Trends actually supported that belief. So if you Google the carry trade explained, that term, into your Google search bar, they can track it all the way back to the early 2000s and how frequently Google users are searching for that term. And it's probably not surprising to anyone in this room that spiked precipitously at the beginning of August. So before we dive in, I know we have a lot of very intelligent people in the room. I think it's important just to kind of go back to basics on what is a carry trade. And very, very simply stated, it's really the return or the cost of holding something through time. And I'm sure people in the room would have other points to add to that definition, but just as a level set. And I think some examples bring this to life as well. So if we think about 3 different examples, you can have the interest rate carry trade, currency carry, which is, of course, the focus over the last few weeks, and then commodity carry as well. All of these are investments that Simplify utilizes within our strategies and vehicles. So for interest rates in particular, thinking about banks borrowing and then lending, the differential or the spread between that can be seen as a carry trade. Of course, currency carry is borrowing in a lower yielding currency and then investing in a higher yielding currency. And again, that differential or spread can be viewed as carry. The commonality across all of these examples in the carry trade space, though, is that they do require a differential or a spread in order for there to be a profit to harvest. And the other commonality is that anytime there's a market disruption or volatility felt within the market ecosystem, that can really cause these trades to unwind, unravel, or become unprofitable very quickly. And of course, what we saw at the beginning of August brought that to life with the unwind of the yen carry trade. But today's panel is not to talk about that trade in particular. We really want to take this back a step, kind of zoom out and think about from the current landscape. Everyone in the room and who's joined us on video, I think, understands we're now in a higher interest rate environment than we were coming immediately out of COVID. But we're starting to look at global developed central banks cutting rates, looking at easing monetary policy. And so what are the ramifications of that on carry trade, which requires a spread or higher rates to compensate investors? So with that lens in mind, let's jump right into today's topic. And let's start with the macroeconomic backdrop, because I think all of these variables are really imperative to think about the ability to harvest a premium or a spread or introduce carry within a portfolio. So maybe I'll start with Ed from a macro backdrop. Can you set the stage for us in just thinking about some of the things that are relevant today from a geopolitical risk? One of the things I think that just hit the news in the last 24 hours is thinking about some of the port closures, obviously heading into the election this year. I think Ed has some interesting thoughts to share, and then we'll kind of shift gears to talk about interest rates in a bit.
Yep. So I'll start with the ports because something I've known for 25 years, but also something that I think has the least impact in terms of what's going to move interest rates. So my sense is the East Coast port, typically when we have a port action on the West or East Coast ports, the president steps in and sends the labor back to work within a week, on the outside 2 weeks. Really hard to know right before an election like this if that's politically possible. What I can tell you is shippers have already taken a lot of action beforehand. So most of the goods that come into the East Coast are already in for the holiday. A lot of the goods are going to the West Coast anyway in terms of consumer goods. COVID was an incredible lesson further for the logistics of how to move things and deal with inventory and provide places to store things differently. So I really don't think there's going to be a big impact. Most economists you hear, including ours, believe there'll be a 10 or 15 basis point drag on GDP in third quarter if this goes over 2 weeks or so. I don't think you're going to really notice it, and so I don't think it's the big issue to focus on. I've seen many of these port things happen, and every year the shippers get smarter, and I think right now we're in a good place for that. On terms of what I think is really going to move the markets most, and obviously there's so many geopolitical things, it's the Fed and it's the labor market. And so just to put things in context, obviously the Fed cut rates 50 basis points a couple weeks ago, first cut since COVID in 2020, so in 4 years. And where we are right now is 5% rate basically. And the Fed has plotted a course where they'll cut another 50 basis points they've laid out by year end. There's 2 more Fed meetings in November and December, so theoretically 25 each, which would take us to 4.5% at year end 24. And then they've plotted another 100 basis points for 25, which would take us to 3.5, and then another 50 for 26, which would take us to 3. So going from 5.5 before the first cut down to 3, 250 basis points. A typical cycle, if you look over 45 years of Fed cutting cycles, is about, I want to say it's 500 and something it's 326 basis points. So this would be 250 basis point cut, which implies a pretty clean landing and things are pretty good. If you look at future markets, they're not giving the Fed all that much credibility. They're saying things are going to happen faster. So the future markets are discounting 3 cuts by year end, not 2, and 5 in 2025. So getting from 5.5 to 3, but in a faster rate. Again, the Wolfe view from our chief economist, Stephanie Roth, is that so much of this is going to be focused on the labor report. The next labor report comes out this Friday is critical. And it's critical in terms of 2 things to focus on. One is the unemployment rate, and the second is the non-farm payroll. The unemployment rate for the last 20 years has basically been around 5% on average, and it's gotten down to 3.5% right before COVID in 2019. It was at 3.5% in 22 and 23. It's been creeping up, and we got as high as 4.4 in July. That's what spooked the markets when that was reported in August. And then it came back in August, reported in September, down to 4.3. So Stephanie believes if we get a lower than 4.4 reading, markets are going to feel good and sigh a little relief, and that's the likely call on this Friday. If we get above 4.4, you're going to see some volatility in the markets. In terms of non-farm payrolls, historically over the last 20 years, about 150,000 a month is the norm, and the last 3 months were revised down to about 116,000, and consensus is calling for 145. So I don't think people expect the consensus to be hit. Below 100,000, we think you're going to see a lot of volatility and pressure on markets and a call for 50 basis points. Above 130, I think you're in pretty clear sailing. Between 100 and 130 on Friday, and we're kind of in a gray area. It's going to depend on the rest of the readings there. So I think those are the main drivers. Obviously, you've got the Mideast, you've got elections. We have opinions on all of those things, but I think that's the driver.
Yeah, perfect. Thank you. Charlie, any thoughts maybe as it relates to impact of interest rate policies on commodities? I know that's within your wheelhouse, and just thinking about from a macro perspective, where we are in the cycle and any impact on commodities in the year ahead.
Yeah, I think you've got always 2 forces at play in determining the commodity price, supply and demand. There's some pretty complex interactions between the cost of capital and the development of supply and demand going forward. And I think it's quite helpful to think of them not just in terms of supply and demand, but also short run and long run. In the short run, when interest rates are high, the supply chain basically optimizes its utilization of working capital and destocks inventories. And that tends to suppress commodity prices because more supply comes out of storage for the simple fact that it's more expensive to hold stuff in storage. And that has a depressive effect on commodities. However, in the long run, On the supply side, higher rates generally mean that the cost of capital is higher, and the IRR hurdle for building new projects to bring new supply online is higher. So you have this sort of confounding effect, which is it depresses prices in the short run when rates go up, and then raises prices in the long run because of the impact on the supply side. And then on the demand side, to a first approximation, commodities and rates are correlated because they're both representations of inflation at just some very basic level. So you have these sort of confounding effects with the supply side, but at the basic end of the demand side, when rates are high, oh, is my mic broken? Thanks, everybody. Appreciate that. Oh, nice. So yeah, so higher rates fundamentally mean the higher inflation at some level, and that is typically going to mean higher commodity prices. So yeah, it depends on what lens you look through it. But I would generally say that if interest rate volatility is higher, you can expect much higher commodity volatility because of the ongoing dynamic and non-stable interaction of these forces. And what that means as an investor, when you're looking at commodities, is I don't think you can just buy and hold something. Like, it's great to believe that copper is fundamentally undersupplied for the next 30 years while we electrify and everybody needs to own copper. But when people were saying that copper was the best trade ever 4 months ago, it subsequently sold off 20% like 2 weeks later, right? So these things are moving fast. And what that means is, as an investor, you want to be dynamically reacting to changing conditions. And I think that's the most important thing. And then the last point I would make is, when interest rates are high, everybody's line of sight compresses. When interest rates are zero, I can see 100 miles 30 years into the future. I care about what dollars are worth in 30 years' time. When interest rates are 5, I don't care at all. Like, that's the infinite future. So your time horizon shortens, and the higher rates are, the more you're only looking at the hand in front of your face, right? So you're shortening the wavelength of the things that the market cares about when interest rates are high. And that has a really, really big impact, I think, in terms of the way the market thinks about commodities, and in particular, stories that have a longer wavelength when rates are high just don't matter as much as the pulse of supply and demand right now, right? So the higher rates are, in my opinion, like, the shorter the wavelength of the market, and the more adaptive you need to be. And practically speaking, looking forward, it means you need to trade more actively now than in the past.
So maybe staying on the topic then of interest rates and where we are today, where we think we're headed over the next couple quarters and years, really the impact of the regime shift from more of a tightening to more of an easing cycle, and thinking about the steepness of the curve, kind of tying this back to today's topic, which is the return of carry, and thinking about that environment that provides for attractive carry trades, a steeper, higher interest rate environment, and more of that curve steepening. So any thoughts? And I know, Ed, you made a comment around the market pricing in future rate cuts versus where the Fed's dot plot or their projections are. So any thoughts from anyone here in regards to the slope of the curve and what that means from an opportunity perspective for carry trades?
Yeah, and let me put that in context. And I love everything that Charlie said, because it is fundamentally true and valid. Let me just try to give you a framework for it, okay? Because I think what you're talking about when it comes to commodity fits in a kind of a cleaner framework when you think about return drivers as really falling into 3 categories: carry, value, momentum. Momentum is the return you get when things keep going in the direction they've been going in, okay? Value is the return you get when things switch directions, okay? And carry is the return you get when prices don't change. That's the basic way to think about carry. And so you look in that, through that prism, and by the way, you were talking about supply and demand as rates are higher and lower, and that's the whole point, right? Which is, in the short term, you're gonna have things like compression of supply and all of that. But the fundamental thing that Charlie hit on, which is right, is as rates go up, carry matters more, in a variety of ways. I love the way you verbalized it in terms of, the horizon changes, the way the focus on the lens changes, right? But is it shocking that we've had this window of time, the last 2-ish years, where we've been talking about the return of carry, and now I'm like, question mark, maybe? Who knows? But the point is the following: when interest rates are zero, carry is really darn hard to come along, right? Because remember, the whole idea is the return you get when things don't change. Well, the easiest way to make a return when things don't change is to buy a treasury and clip a really high coupon, right? And by the way, it opens the window to a bunch of like kind of fun financial engineering things, right? I mean, if you're talking about this horizon shrinking and expanding when rates are at zero, and like we're having a conversation like, give me $100 in a year, give me $100 now and I'll give it back to you in a year. When rates are at 5 and the financial engineering homework is give me $100 in a year, I know the answer. Give me 95, I'll buy a treasury, we'll be all good, right? So all of a sudden you've got this time and place where this window opened. We've had the, carry, and I'm giving you kind of the high level theoretical version of it, and of course it's had applications in interest rate differentials and currencies and commodities, you name it, right? But we've had this moment in time where rates have been high, and this is the second piece of the puzzle, because remember, carry is the thing you get when prices don't change. Rates have been high, volatility, particularly equity volatility and most other volatilities, with the exception of interest rates, have been low, which are kind of like the things you need to put you in a mind frame where carry is the thing. People are thinking prices aren't going to move a lot. That's what it means for volatility to be low. And so we've had this world where these things have come together. Charlie is kind of giving you the on-the-ground version of it. And as I told you in my intro, the option theorist and kind of the global head of PSA for like how do we think about this going forward? What happens if rates come down and volatility goes up? Well, the world changes, right? So obviously, think about things like some of these fun products that have cropped up in the last 2-ish years, and some of them have gotten super popular, and we'll touch on some of those hopefully later. All right, let's think about what happens to those when rates come down, possibly, and volatility goes up, possibly. And so that's the way I think about the moment in time we find ourselves in today.
I would just throw in 2 fundamental things about supply and demand that are not so related to the economy, and that is we have a lack of residential housing supply that is unique in this time period. That really started out of the Great Recession and then picked up during COVID. And that's going to have upward pressure on inflation for the next couple of years. On the other side of that, we have a glut of oil in the market, and we're oversupplied. And despite all what's going on in the Mideast, oil is coming down pretty consistently, which is shocking almost. So those are just 2 things to think about when you think about what could stop the Fed from cutting inflation moving one way or another, or increase the magnitude of that.
I'd like to build on kind of both points. Firstly, on what could stop the Fed. It's interesting that the lack of housing supply and the inflationary impulse that it creates would create a response function, which is let's suppress demand and equilibrate the market that way, instead of let's make capital cheap so we can build more supply, which is the actual problem. I think the Fed has this sort of pathological over-focus on demand management without enough, and they sort of put the supply side, that's all about fiscal policy and what do we want to encourage and permitting and all this stuff, but demand management is not the only tool in the toolkit. And we would see much higher productivity growth if they were more focused on accelerating supply formation. So that's the first thing. I would say, and on the oil market in particular, I have no edge predicting geopolitics, but I would just add that if whatever the retaliation is that comes from Israel meaningfully impacts the supply chain in oil, which seems quite likely, that could indeed have a very strong supply side bad inflationary impulse into the market. It might also piss off the Chinese quite a bit because they import basically the oil in the supply chain that way, and put a pretty big damper on growth. So it's like a super high risk situation. That's actually probably a pretty good entree into thinking about the carry trade more generally. So when you think about the carry trade as a risk premium, what do I get paid if nothing changes, right? Well, if nothing's going to change, it's usually pretty attractive to borrow money to put it on and capitalize on these differentials in returns between the asset side and the liability side. And so when you're thinking about carry trading in general, it's really important to think about not just what might happen to your asset side trade, where the basic bet is nothing's going to change, right? So as a credit investor, you're like, cool, well, if nothing changes, I get paid back. If something changes, the company I'm invested in goes bankrupt and I've got a problem. But it's always a sort of what could change question, and usually the answer is the modal outcome is nothing, right? And then there's some tail risk that you've got to underwrite, and that's the asset side. But the liability side, I think, is much more tricky typically, and you can't carry trade without thinking about the liability side because a balance sheet has two sides. And generally speaking, if you've got some sort of liability structure on, everybody else has it on too, and that's what we've seen with the yen trade earlier this year. And so I think the reason carry behaves like a short volatility construct in the market is because you can't be as levered if assets are more volatile and liabilities are more volatile. And so if the liability side of the trade always comes down, basically, in my opinion, to thinking about what's a sustainable leverage multiple the market can run, which is really a question both of crowding and volatility conditions. And what I'm always looking for in my firm strategies is the idea of the stability of cross-asset correlation, because fundamentally carry trading is owning one thing and borrowing, pledging it to borrow something else, right? So it's all about cross-asset correlation stability and the volatility, and recognizing that the correlation of behavior on the liability side is a big question to ask. So I think, for example, a month ago, at the end of July, or 2 months ago, at the end of July, early August, when the market imploded and we had this sort of localized vol spike, right? That to me, who knows, right? It's hard to know, but that to me looks like people are more levered up, right? Because you don't often see a chart that's got the BART pattern, which we used to call in crypto trading. It's like up, down, right? Or an inverse BART, down, up. That's a function of people trading on high leverage with tight stops. Mm-hmm. Right? And that makes sense because active trading world is getting more and more concentrated in just a few multi-strategy managers where there's a centralized risk function. Right? So I don't know if that's exactly what happened in the market. I think theories could differ, and I certainly don't have any specific information about any particular shop. And I note their performance has been generally okay. But the behavior of the market seems to be like greater concentration with higher notional leverage and tighter stops. And if that's the case, carry trading can be great, but you need to adjust quickly, right? And again, the idea is as the world changes, you want to react more elastically to new incoming information than you would before. And that's kind of my view on carry. So yes, an attractive risk premium, but you want to be active timing it much more so than before.
And if I can just build on that for all of 10 seconds, what you just said is again, kind of critical to it, which is, I think if the premise is, hey, this thing works when the world doesn't change, if you've been in the market for a minute, that's a pretty flimsy proposition. And so again, this is about leverage. It's about, what kind of margin call can I get and can I live through it? And as a result of that, it's about risk management. And the thing that worries me when it comes, again, as some of these things that used to be the province of only extraordinarily sophisticated investors with, permanent capital and all the things that kind of allow you to survive really bad events, as these things kind of become more broadly available, you better hope that at a minimum, quote unquote, your person has these attributes, significant risk management in place, really thoughtful about leverage, down the line. Because I repeat, I don't walk around the world thinking the world is not going to change is a reasonable place to kind of start. So that's the way I think about it.
Yeah, maybe a follow-on question, just given some of those discussion points, is thinking about where we are in the rate cycle as most developed countries are starting to ease policy, interest rates are coming down. Is it as simple as saying lower interest rates reduces the ability for attractive carry trades that come at, risk-free, right? I think the takeaway I'm hearing here is as that spread starts to condense, as market volatility starts to rise, perhaps additional due diligence, understanding within a broader portfolio construct how these trades are benefiting. So maybe let's just stay on the topic of risk, and then we'll loop back to more of the implementation topic. Jonathan, when we were having a conversation before today's panel, something that you mentioned, I thought it's very simple but profound, is risk aware versus risk averse. And so although we are discussing the risks, as any prudent investor would, there are opportunities as well. So maybe on that note of risk aware versus averse, how do you think, especially as you allocate for your clients and thinking about the benefits of these types of trades or strategies within a portfolio. How do you balance that? And what are you looking for as you're building portfolios?
Yeah, and it is shocking how important this point is, right? Which is, I talk to people who are very sophisticated and still, like some of them are like 80% in cash. So that's risk averse, like that's fetal position risk averse. And honestly, like I'm whether or not I think that's optimal, I have some sympathy for someone who hasn't seen, kind of 5% treasuries for a generation. And I was sitting there like, this seems to me like a gift. And I'm like, yeah, no question, but how much of this gift do you want to, take and for how long? So I want to have sympathy and a place of understanding that risk aversion in the moment we've been in is reasonable. Now, of course, the mind of the investor is a complex place to inhabit, and so you've got things like risk aversion and then like FOMO, right? And so like you got to live in that really complicated world where there's kind of real risk and psychic risk. But I live in a place of risk awareness, right? Where it's like, I repeat, you don't want to be in the fetal position. That seems to me like not a super viable place to be long term, and we know a lot of people are. I mean, that's how we end up with the amount of money that's in money market funds and so on and so forth. But what Ed was saying is I think a very sensible baseline. We all live in a probabilistic world where like a baseline isn't the final answer. But what do we know? Rates are going to come down possibly a little bit more. Are they going back to zero? I mean, I don't think so. I don't see that unless we really run into a ditch. Do we have a tendency to do things until we run into a ditch eventually? Yeah, 100%. That's like your Minsky cycle or whatever you want to call it. When things are, it's like the old thing. Like they put seatbelts in cars and everybody started driving faster. So that's kind of the situation. But if rates settle in the 4-ish, maybe even top threes, like that's not zero. That's a number different from zero. It ain't 5 anymore, but it's not zero, right? Risk aware, I think the unemployment projections, I don't want to use the wrong word, but what you're saying is right. And the reason why the market got spooked is, look, and you don't have to run regressions to do this. You look up the unemployment statistics going back to 1948 or whenever this started, and you're pretty quickly convinced that unemployment has a nasty habit of snowballing, right? The thing doesn't go like super, super low and then like a couple of ticks up and then like that's okay, that's where we're going to be. The thing kind of whooshes, right? And so my statistics are the same as yours, which is if you go back to the beginning of the 21st century, the median unemployment number has been some version of 5.5. We were sitting at generational lows at 3.5, which has now become everybody's norm intellectually, which it's not the norm. It just happened to be a time and place where supply and demand of labor were kind of, tested. And because of the snowball, kind of process, we could wake up at 5.5 and it wouldn't be, one, the worst thing in the world, and it wouldn't be utterly surprising. So I'm aware of that possibility. And still, I promise you, the headline, if we wake up at 5.5 and like, I don't care when it is. I don't care if it's in 6 months, a year, or 2 years. No one's going to go like, woohoo, we're back to median, high five for the soft landing. People are going to freak out. And so that's what I mean by kind of thinking holistically about risk, is think about the probabilities, think about the reaction function, and given that informed understanding of the range of things that could happen, what's a reasonable place to be? And it's not going to be 10x levered on something that has got instability and margin calls, and it probably isn't going to be 100% cash.
So we have about 10 minutes left, and I want to tie this back again to the theme of today's session, which is the return of carry, and really thinking about walking out of this room and having ideas for implementation or how investors are thinking about introducing carry within a portfolio. So would love to hear whether simplistic or uber complex, thinking about ways that investors today are implementing carry within a portfolio. And Charlie, let's start on this end, on the maybe more sophisticated institutional lens.
Sure.
And kind of tying it back to what you're doing on a daily basis within the hedge fund.
Yeah, so I think firstly, I do think carry is an interesting risk premium. What do I get paid to warehouse balance sheet, warehouse risk, assuming nothing bad happens, it's basically like what's the rent you get to charge for the warehouse if you're in the storage business for risk, right? And that's a there's a moving business in risk and a storage business, and the storage business sometimes is really good, right? So I do think it is a viable risk premium overall. It should be blended with other risk premium in the context of diversified investing. So I am a fan of carry. We do use it in our futures trading systems. In a previous life, I ran a mortgage desk at Goldman Sachs, and we were big time into carry there in structured finance, and I might even start there. In private credit, I'm particularly interested and attracted to carry trades in the form of balance sheet provision for asset-based lending. Right, it's better to be paid a little bit of excess premium for illiquidity if that illiquidity is reasonably short in duration with a lot of over-collateralization than it is to warehouse a lot of macroeconomic risk on corporate defaults. I don't think high yield spreads are particularly attractive. I think it's a strong argument that in this higher rate environment, some of the leverage on corporate lending is not sustainable. I know my good friend Mike Green agrees with me on that one. And but I think there is quite a lot of pricing power for balance sheet in certain types of asset-based lending. Altis does not yet provide any product like that, but maybe someday we will. Maybe someday Simplify will. I guess you do sort of do an MTBA already. But those types of asset-based risk premia, I think, are attractive as more as credit spreads as opposed to levered funding arbitrage like you get in interest rate curves or FX. So I think that is one place to look, which is totally actionable. And interesting, whether it's in ETF format or in private lending format. And I know there's quite a lot of work across the asset management space blending those two things. Moving on to active trading world. Again, my strong view is the world is changing a lot faster than it used to be. If you just kind of take a 3-sentence story of the market in the last 15 years, basically what happened was the system blew up in 2008, and then the government decided to suppress volatility. Then nothing happened for like 12 years, basically, because the government didn't want anything to happen, and carry was awesome, and bonds rallied a lot. That was great. Then COVID happened, and the world changed in a very specific way, which is the government went from suppressing volatility to actively inducing volatility. Whether it's lockdown, trade policy, tariffs, starting wars, an aggressive monetary authority that wants to kill startups, you name it, the government is in there, the long hand of God is stirring the pot. And what that means is the market is moving faster and things are fundamentally changing faster than before. And so if you are, as an investor, are deciding what risk premium do I allocate to and how fast do I change my mind, at one end of the spectrum is I ignore information and I dollar cost average and I just buy passive stuff because information is useless. That's one extreme. And the other extreme is I turn my book over 200% every day and bleed out on brokerage fees. Right? Wherever you were previously in both those extremes, both of which are pretty dumb in my opinion. I know that dissing passive might be somewhat controversial, but I'll die on that hill. The middle of the road, right? Wherever you were before, you want to be on the more reactive to incoming information now because the government is changing the world faster. Right? So you'd be in a bad position if you ignore that information. What that means is in our systems, we try to think about when does carry work, when doesn't it work, how much does it work. I don't just believe a yield is an expected return. We think about more like what is the yield telling us about the expected return statistically, and we try to adapt dynamically. And that design principle is we want to be more adaptive than before, I think pertains. And again, we look at everything through the lens of volatility. In other words, yes, it's a good risk premium, but how diversified do you really want to be on it? That's a function of the stability of both the asset side and the liability side. But the bottom line is futures are awesome and you should trade them. And so managed futures product that incorporates a carry signal should give you, in what is in our opinion, the right amount of exposure to that when blended thoughtfully with other risk premia. And so I'll leave it at that.
A comment that you made to me a week or so ago is a comment on focusing on markets which have greater pricing power. So as you think about the landscape of opportunity, what are some of those markets in particular that might be for more the common investor to capitalize on from a carry perspective, whether through active or passive?
I'm going to punt on passive.
Yeah.
But I think, again, it's a question of where the market is capital constrained and your capital has the higher pricing power. And right now, again, I would say active management is popular and growing in ETF world, but generally speaking, it's under allocated to overall because passive is taking more than 100% of new inflows. So active management, anything that's providing something other than buy and hold liquidity to the market, but providing more short-term or medium-term liquidity is likely to have a higher pricing power. So any kind of rotational strategy, factor-based, sector stuff, quant product, some active management. I think all of those things, as long as the wavelength is something other than I never react to incoming information except on invest and redeems, but I actually change my position on the basis of something other than flow of funds in my own product, I think you're probably heading in the right direction. So again, my strong view is the next 10 years is about alpha, not beta. And it's actively managed QIS products, whether they are futures-based or equities-based or OTC swap-based or otherwise. And I would handily note that Simplify has a suite of all of those things. But that kind of thing.
Awesome.
Active product.
And we did not ask Charlie to say that, so thank you.
You're very welcome.
Jonathan, maybe shifting gears, but on the same topic and thinking about the clients that you're allocating assets for. Obviously, different access point, a different need within their daily lifestyle versus maybe a hedge fund type client. So how do you think about the opportunities and ways for your clients to access the carry trade?
Yeah, and again, there are only so many kind of long shelf life principles out there, right? So what Charlie is describing in his space applies in my space, and I give you one axis to get oriented early on, carry, value, momentum, and I'm going to give you another axis which Charlie just hit on, and I think it's worth elevating, which is there are two ways to allocate capital. You can be a liquidity provider, you can be a liquidity taker. So just think about these two axes for a second, okay? Just waking up in the world with a stock portfolio, like, a lot of people do, you have a tendency to be exposed to momentum. How do we know that? That's kind of the way passive plays, okay? So we'll just put a pin in that, and we're not gonna get much further than that, okay? So if you think about your financial diet, I would surmise that a lot of people have momentum. They don't call it that, they call it beta and so on and so forth, but you got that. And it makes sense because of the way these things are built, and it makes sense because people are walking around with a bunch of FOMO. And so there's a tendency to want to buy the things that have gone up. Buying the things that have gone up is liquidity taking. So there you go, that second axis, okay? Then you've got value, which people are aware of, buy cheap things and so on and so forth. They get it, they don't do a lot of it because it feels yucky. You buy a bunch of dogs. That's kind of the energy behind it. But that's kind of diversifying, I guess, from the first thing I told you about. And importantly, it's liquidity providing because you're buying the dogs, the things that people don't want to hold because they've made them feel bad, okay? And then, so that's already kind of the way to get oriented as you're helping people kind of diversify from their home base. And then there's this last thing called carry, which is, and again, as a student of data and theory, I will tell you, carry is real. Okay, this is not a figment of one marketer's imagination. So carry makes sense as a diversifier because it is a differentiated return driver. And, handled with care. All the things we've talked about, the kind of the leverage and the risk management and blah, 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 right? So one thing to keep in mind is as you engage in moving away from where you started, which tends to be a boatload of bulk beta, which has a touch of momentum in, you're diversifying. That's the word that people like to use, but diversifying, one of my former colleagues used to say, maximum diversification is signing up for maximum regret. And the reason is because you hold a bunch of things at any given point in time, one of them is gonna look bad, right? And you're gonna feel bad about it. That's just the way the mind works. So just acknowledge what this is about. Acknowledge the fact that these things have cycles, these things have good outcomes, bad outcomes, and again, get oriented on this carry value momentum versus liquidity taking, liquidity provision. It tends to be that over the long haul, things like providing liquidity, warehousing risk are a pretty solid place to be.
Yeah, and we have about 30 seconds left. Ed, did you have a comment?
Yeah, I want to give two ideas quickly from the equity side. One, there's an ETF at Simplify EQLS, and it's a true long short machine learning built product that should be agnostic to whatever the economic cycle and interest rate cycles are. It is built to really outperform in crisis and illiquidity times. So it's a great place to perform well when the markets are, but be underperformed when the markets are at their peak, but to hold up incredibly well under the most stressful tests. Second trade that I want to talk about, which one of our analysts has had on since January, and people were looking at him like he was nuts until 2 weeks ago, is long Chinese technology and short US big tech. And you couldn't find an investor to want to talk about Chinese technology for a number of reasons and risk. And today, 2 weeks ago, China dove in with all this stimulus, and the Hang Seng's up 19% and now is closed for holiday. But you see the impact right now of that stimulus, and the Mag 7 and other big tech were clearly used as hedges and parts of carry trades. And the reversal of that we saw and we've seen now gradually over the last 6 months is really interesting to watch. So you can actually make a carry trade out of 2 different equity groups if you screen those stocks well enough.
Wonderful. Well, we are up on time. I want to thank Jonathan, Ed, and Charlie for joining me today. And I think it goes without saying, but Simplify, as the name implies, really seeks to demystify a lot of these pockets of the market that may be overwhelming or have a lot of nuances to them. So our website has a lot of material from an education perspective, and just want to thank everybody again today for joining us.